following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
All right, and that fancy theme music means it's time once again for Volatility Views, your weekly source for all things volatility related, or we try to make it weekly. Sometimes we're a little bit off schedule, as we are this week, but we're a little late, but none the worse for wear, because that just gives us even more things to discuss on the old docket today. And speaking of the old docket, joining me for that discussion, first and foremost, none other than the Viceroy, indeed the Major Domo over there at the Volatility Exchange, good old Don Schlesinger. Don, welcome back to the show, sir.
Thank you. I'm excited about two new titles, Viceroy and Major Domo.
I was going to say that those are your official titles, aren't they? I pulled that from the official Volex record. I'm sure Bob is okay with that.
Right. Put it on the business card.
Perhaps Archduke also could fit in there. That's a good one. And also joining us on the old Volatility Views panel today, none other than good old Mark Sebastian from OptionPit.com. Mr. Sebastian, welcome back to the show, sir.
Domo arigato, Mr. Roboto. Domo.
You've been listening to a little Styx over the weekend, I take it.
I have. It's like I'm sailing away.
Don, I don't know if you haven't listened maybe some of our other shows, but we can always count on Mark for a good 80s reference. That's a very early 80s. That's like 1981.
I know.
That's about as early as it gets.
Come sail away with Don.
I think actually, now that I think back on it, that might have been my first ever record that I recorded. Oh, I think it was that and perhaps one of the Disney, Mickey Mouse records.
You had like Pete's Dragon where you follow along with the book.
Yep, and that and Styx. It made perfect sense.
Pete's Dragon.
I mean, people
Dragon.
forget those albums used to be concept. They used to have, like the Styx album was, all kinds of robotic stuff in it. And there was a story. It was great for a little kid. It was fantastic.
Yeah, well, yes, no, there's actually video of me singing that song when I was like 3 years old. But do you remember like before?
we need to find that video and post it on Options Insider for all to see.
And VHS. What you used to get if you loved a movie was you'd get a storybook and a cassette tape.
Yes.
And you would put the cassette tape in, and it would be like somebody telling a story, and there would be clips of the characters talking to each other from the movie, and then it would say, when you hear this sound, boom, or
flip the page,
turn the page. And then you'd sit there, they'd play a thing, you'd read your little book, and follow along with the story.
Kids today, they don't know how lucky they are.
They are. Well, of course, back in Don's day.
I was going to say, this must drive Don crazy hearing us going on about nostalgia.
All Don did was read people stone carvings, is my understanding.
Yeah, it's to unroll the parchment as you would turn to get lower.
I didn't realize cuneiform was so big on the Morgan Stanley desk back in the day.
Don just calls them the Sea Scrolls, not the Dead Sea Scrolls, because he was around before the sea died.
Yeah.
Oh, Don. Without further ado, then, before we can make any more ageist jokes and offend a good portion of our audience, we're going to dive right into the Volatility Review.
It's time for the Volatility Review.
All right, and welcome to the Volatility Review, and this is, of course, the portion of the show where we look back on what typically is a week's worth of action from a volatility perspective. But one of the nice things about getting a little bit off our schedule, we're recording a day late here on Monday around 1 Central Time as opposed to Fridays. That gives us an extra day and also the weekend to include in our analysis. There's been some interesting stuff going on. I know the week before we discussed how people were actually buying vol into the weekend, which was a surprising development given what we've seen of late over the past few months from a volatility perspective. Didn't see so much of that this weekend. Vol didn't really get the incredible boost, but didn't sell off as dramatically as it has going into the weekend either. So perhaps there's something to be said for that. But VIX, for the most part, I think last week, would you agree, Mark, relatively underperforming the moves we've seen in the broad market?
Well, yeah, except we've now had kind of one of the big moves fall off, 10-day vol. So really, if you look at, and Don, I'll give you this, realized vol for the S&Ps last 30 days, Mark, 9.25%. The VIX, 14.25%. Which one, I'd want to be short the VIX here. And that's why we keep going higher. Relatively speaking, this market is heavily insured. And you add in what I like to call our free money from the internet, Ben Bernanke's monetary action, and you get a situation where we blast higher and we creep lower. It's like they've taken the old saying, we take the elevator down and the stairs up and turn it on its head. Now, is that going to be that way forever? No, I think we're going to have one day where the elevator, drops into Middle Earth somewhere. But, it's interesting to watch how volatility has changed. Volatility has existed in the last 3 months on rallies, not on sell-offs. Don, you've seen, I know you guys track S&P realized vol. Are you kind of seeing the same thing?
Yeah, it's an unusual year. I was actually reading an article about that the other day, and this concept of VIX actually going up when the spot and when the index is going up has been a phenomenon, as you just pointed out, that has been occurring with a great deal more regularity this year than in previous years. And so it's something that we've actually been studying a little bit lately in this paper that I was referring to last week that I'll talk a little bit more about later. But the concept of VIX being very heavily negatively correlated to stock prices probably turns out, and especially this year, that negative correlation holds much more strongly for down markets than for up markets, which is not to say that when the market rises, generally speaking, VIX sells off, but that negative correlation is not nearly as strong to the upside of the equity as it is to the downside, and it's what we've been seeing a little bit more of this year.
It's interesting that actually strengthens the argument for some people who've been advocating, and we've seen more people advocating for this over the past year, I'd say, is using the VIX either, not so much the typical just VIX upside, but more VIX verticals or maybe VIX time spreads as the hedge, because if you're getting that bang for your buck now in both environments, you really want the VIX for the downside move, but if you're getting that extra little pop on the upside as well, that kind of just strengthens the arguments for in favor of the VIX hedge as opposed to what I think I used to side with a lot more frequently, which was the direct downside S&P put spread hedge, which I think most market makers tend to prefer because that's the more direct beast. But if VIX is getting that extra little pop on up days, that's a little bit of an argument in its favor now.
And again, I think one of the real reasons for that is also the absolute levels that we're at the moment. Mark often refers to that, and I think it's very important, and you mustn't look at things in a void. Everything that's just been said is true, but it's all playing out at the 13, 14, and 15% levels of VIX, and we rarely see it much lower, in terms of historical lows, not for realized volatility, but for implied as measured by the VIX. We're really at the very, very low end of the spectrum here.
Yep.
And so we really just have an argument for people almost closing their eyes and saying, I don't care if the market goes up or down. There's not a whole lot in it for me to be selling 13 or 14% VIX or implied volatility. And so if this whole thing were playing out at a completely different level, I'd venture to say that VIX going up when the market goes up wouldn't be quite as prominent or as frequent as what we're seeing now down at these very low levels.
That's funny. I guess back to what we've talked about a lot on this program and also on the option block, Mark and I particularly, is just that whole notion of contextual VIX and what VIX means at different levels with the VIX cash in and of itself, and then also in relation to the S&P now. And we're at this very bizarre point on the curve where the S&P is relatively inflated, VIX is relatively deflated, and which is following the path relatively nicely, but for the most part. But it does create these odd scenarios like we're talking about now, where the VIX is poised to perform perhaps a little bit differently, a little bit more erratically than what we've seen at other
levels.
levels.
The thing you've got to remember is that when you've got super low vol like that, it begats a kind of a steeper curve. And because of the VIX, some of the VIX's call them imperfections, the curve can really have a strong effect on VIX itself. If you look at straddle vol or at the money vol, it's not that inflated. It's that way out of the money stuff. Basically, the whole market has protective puts or collars on, which in and of itself makes sell-offs a lot harder to happen. When you're well hedged, you typically don't flip out of your position, right? If I'm long Apple, Apple's off $15 today, but if I was long Apple and holding the 680 put, am I inclined to dump my Apple stock? No, right? And I think we're seeing something similar. We've got a bunch of people, we've got a market that's holding a 1455 strike, or is holding a 1455 cash level, but is long, on October 1400 put for $5 and a 14.8 vol. They got, am I inclined to sell at that level? The answer is probably no.
No, that kind of might sound a little counterintuitive to us as, market makers who, when you get some pop on your hedge, you sell it and you trade around it. But a lot of people come in picking up these hedges for precisely that reason. They want to sleep at night. They want to be able to maintain their longs and not have to worry about the near-term vacillation. So they're not going to dump that hedge at that level. So that's kind of the reason they have it. Yeah. Don't invoke that man again on this network,
that
sir.
Idiot.
You can't have all these inside jokes. People who didn't tune in last week.
Yeah, you're right.
Well, that's people that didn't tune in last week. It's their own dumb fault for not listening.
And I don't know that we want to bring it up again.
Listeners, if you want to check out what we're talking about, by all means, check out last week's episode of Volatility Views, or of course, a couple of the episodes of Option Block from last week, where we discussed this, let's just say, intriguing remark from a buy-side money manager about his predilection to go to cash rather than buy a put on his long equity positions, which is, as you might imagine, provided a lot of fodder, a lot of grist for the mill for us. Oh, and before I forget about it, Mark, I like your use of begots and begats. I didn't realize we had entered the biblical portion of the show here. All right. And of course, we also like to delve into the realm of realized and implied in NASDAQ land, aka Apple Plus. I like throwing that in there just to get you motivated a little bit, Don. But what were you watching? I imagine it's a bit of a similar story for you, looking over at NASDAQ land as we've seen kind of in the S&P over the past week.
Well, it was very dull for both, actually. In terms of realized volatility, both indices wound up the week about only a 0.1% lower than they started. So, of course, that doesn't always mean no volatility. You could have been all over the place and coincidentally ended up where you started, but that really wasn't so much the case here. We didn't have tremendous movement during the week, and as a result, realized vol on NASDAQ actually dropped from its very low 12 and 3/4 all the way down to 12.12. That's 1 month trailing or historical volatility. And similarly, the S&P was off slightly from last week's 1098 down to 1077 for historical 21-day or 1 month calendar realized volatility. So it was a week where at such low levels, we might have predicted that any movement would have been to the upside, but market just didn't do enough to generate that kind of volatility. We're actually at slightly lower levels in both of those indices than we were, I guess, about 10 days ago when we last recorded.
Yes, it's one of those periods where, just like we talked about with the VIX and now here with NASDAQ, just odd times. We're on this kind of point on the curve on both indices where, it kind of prepares us or sets us up for these kind of odd developments like we're seeing now with, things being not exactly as inversely correlated as they maybe were at other points on the curve and other developments like that. So it's a fun beast to watch, and I know for a lot of our listeners to parse, and for a lot of people coming in from even the active and mid-tier retail side who are kind of being introduced to the land of vol for the first time. I know a lot of them are scratching their heads as to what is going on, why are these things happening the way they are. So it makes it interesting fodder for us here on the show, and hopefully for you, the listener, as you're getting indoctrinated into volatility for the first time. And speaking of you, the listener, it's time for the old listener mailbag.
Listener mail. Listeners write in.
All right, and welcome to the mailbag. We love doing this here on Volatility Views because we get such fantastic feedback from you, our listeners. And of course, I want to encourage you, if you haven't already, and judging from your responses, looks like a lot of you have. But if you haven't already, then surf on over to theoptionsinsider.com. Check out our brand new comment system. I know a lot of you used to be familiar with the forums, and we had some great conversations going there. We've added a comment system now to the show and to this website, so you can comment directly on episodes or on other articles that you like on the old Options Insider, and we could see that and directly relate to them on the show. We'll be bringing the forums back in some capacity down the road, too. We haven't decided exactly how the best way is to approach that, but we're working on that right now. But for right now, the comments are very active. We love to see all of you guys giving us your 2 cents, and so that makes it very easy for you to get in touch with us here on the show. You can, of course, also reach out to us via direct email, questions@theoptionsinsider.com. There's also a comment form on the website. You can fill that out. Of course, the old social media, twitter.com/options. Direct message us there with maybe perhaps the hashtag VolViews so we know which show you're referring to. We have quite a few of them. We also have Facebook. You can connect to us up there. You can also, a lot of ways to get in touch with us here at the old VolViews program and on the old Options Insider radio network in general. And we're going to start off with a comment from a user on the website, goes by the handle Lee. And actually, too bad Mark had to run out for a few minutes here on the old mailbag because this one is actually aimed at him. I know he would have loved it, but I'll give him a little bit of a plug. Anyway, Lee posted on a comment on an article that Mark actually put up on our site on the Options Insider called "An Arrogant VIX Trade Story." And this Lee wrote, possibly one of the most honest and transparent posts I've seen about a losing trade and the reasoning behind it. Well done, and thanks for the honesty. We've all been there fighting a losing battle because our head tells us we are right when everything else is telling you otherwise. It really highlights the need to follow a plan, stick to your risk reward no matter what happens, and act like a robot with no emotion when trading. Regards, Lee. And thank you for that comment, Lee. I'm sure Mark would have loved it. Unfortunately, he had to skip out on the old mailbag this week. But of course, you can find Mark's articles on our site as well as many other commenters and many other contributors, I should say, on the old optionsinsider.com. So you can surf on over there and find all of that and much more. Then you too can leave your mark just like Lee here did today on the show. And Don, of course, we've both been there, that moment when, you really, you think, let's say, upside should be much more bid than it is, but you have to come to that, come to God moment where you have to really decide to move your skew against you or mark your options against you.
It's the old John Maynard Keynes quote that I've said before. The market can remain irrational a lot longer than you can remain solvent, and there comes these times when your head says one thing and the market is telling you that no matter how right you think you are, this is going to be a very bumpy ride. And I used to do trades where I was convinced that the logic and the math and the probabilities were on my side. And when they would lose money, my boss would say to me, what went wrong? And I said, you analyze, you do everything you can, but the market does what it wants to do. And according to him, you were right when you made money and wrong when you lost money, period. He didn't want to hear anything else. So.
This was a bit of a rude awakening for me when I first walked out into the SPX pit in my early days on the floor of the CBOE, first cutting my teeth. And when you're trading that product, like you are market making in most options products, you're primarily trading around volatility and volatility levels. And what you would do is that you go out there, essentially, this is early enough where we still had sheets primarily before handhelds, and you'd adjust your skew curves upside, downside, at the money across the different months, adjust your term structure to what you thought was appropriate in the marketplace, what was reflected in the marketplace. But you would eventually develop some axe to grind somewhere. You'd probably be loading up on upside in 1 month or loading up on or be short another month, and so you'd want to mark your levels accordingly because you thought that's where the market should be, when in reality the market was moving in the opposite direction completely. And we'd end up, if you were really stuck to your guns, you'd all of a sudden be $3 over your sheets at $4.50 over your sheets. And we'd see some guys would eventually, they'd resist for a while, and other guys would eventually come to the conclusion they needed to be around to make their markets a little more actively and more accurately, so they would just adjust and bite the bullet and take the hit to their P&L. You'd see other guys clinging to it for weeks and perhaps even months, and they would be $7 over at $8 over on their sheets, and you knew that they were just clinging to a pipe dream. They didn't want to make that P&L adjustment, but eventually it comes back to bite all of us. And that was my perhaps first introduction to the fact that volatility and the market are a bit more capricious than I perhaps first estimated when I walked in there. And they have no pity on you. They have no qualms. It will move against you, and you have to be prepared to deal with that.
Yeah, absolutely.
Next up, we have a question coming in via Facebook from Tom. I guess that's Sevens. Interesting last name. He says, you guys are always talking about the implied volatility premium versus realized, but it seems like implied vol is always priced at a premium to realized, something that Don has gone on about at length on this program over the past year or so. He writes, Tom continues, so is there ever a reason why anyone would want to do the opposite, buy implied and sell realized vol? And that's an interesting question, and it brings up some, I think, interesting scenarios. Obviously, that's a very limited scenario you'd want to do that. I think probably the best example of something like that, something we've hit on, and I think actually in some recent shows, are some days when implied is just at ridiculous lows like it is now, and you have some intraday movement in realized that is just explosive. And it takes maybe a little while for implied to catch up to those scenarios. So maybe off the top of my head, I could think of scenarios like that where you're seeing some dramatic move in vol in intraday realized, and implied is, for whatever reason, a little bit slow to adapt to that. So, but yeah, that's an interesting question, Don. That's one I think that's worthy of mulling over, because it's not something that you typically see in the marketplace these days.
And of course, there's a couple of comments here. The first is that the notion of trading implied versus realized, until we get some of our realized volatility contracts out there, the ability to trade pure realized volatility is really via vol swaps over the counter, certainly not readily available to the average investor or to the majority of our listeners. So the very concept of doing such a trade logistically, what are you going to use for your surrogate for trading realized volatility? Well, we've talked about this dozens of times.
Good old delta neutral straddles.
Yeah, you can try to do it by delta neutral hedging a straddle at the money and adjusting your deltas every night or even more than once a day. But that's fraught with costs of bid offer spreads, and it's path dependent. And once you get too far away from the strike, you kind of lose the optionality and you have to roll. So we've talked about all the pitfalls of that. So let's talk about it more theoretically than what you could actually do realistically in the market, which is a little harder at the moment. This is really just a spread. And you can track for long periods of time implied vol versus realized vol, and you ought to do it with a lag. I'll get back to that in a moment. But you put these up there, and you take a look at the fact that yes, on average, implied is usually 3-4 percentage points higher than realized when we're talking about the equity indices, but with a great range. A couple of weeks ago, I mentioned that we had seen that stretch to like 10-11% with VIX at 19 and 20, while the realized was down at 9. And so basically it gets stretched, and believe it or not, it gets stretched the other way too. They actually do cross, and there are periods of time when, as you mentioned, Mark, you have a tremendous spike in realized volatility, and implied, forward-looking just doesn't want to go along with that and doesn't react as violently. And all of a sudden, you're looking at implieds that are equal to or lower than realized at the moment. So if you have a notion of what the historical mean spread is between the two, then the answer to the question is when that gets out of whack to the extent when realized and implied are close to equal, or the spread actually goes negative with implied lower than realized, then that may very well be a time when you would actually want to be long the implied and short the realized in terms of a spread. The only warning that I would issue here, if there were vehicles to trade both, and one day soon we hope that there will be, is you have to understand the time frames that we're talking about. Right now, when I say realized volatility on the S&P is in the neighborhood of 10-11%, that's backward looking. When we talk about VIX or VIX futures, that's almost like doubly forward looking. VIX futures expire on the third Wednesday, or the Wednesday before the third Friday, and then they actually expire to a forecast of future implied volatility. As we've mentioned many times, a forecast of another forecast. So when you look at these spreads, what you really want to do is you want to match up the time periods. When you finally get the realized volatility for the period that is actually covered by the VIX expiration, you want to kind of move those. You want to translate them in space so that they match up. And what you really want to compare is what was the realized volatility during the period that was forecast by the expiration of the VIX futures, to then see what that spread would actually be. Otherwise, it's kind of apples to oranges. I'm looking at VIX futures today that are forecasting, November implied volatility. And meanwhile, I'm looking backwards for the last 21 days in September talking about realized. Well, you have to understand there's quite a mismatch there.
As you mentioned, Don, it's an interesting idea, and it's certainly theoretically interesting, but the actual implementation of acting on this, it's so short term, because like you said, it's most of these are really very, very bizarre intraday type of events where realized and explodes, and you have this short-term scenario where realized is at an extreme premium to implied. Those are the times when you would want to do that, sell the realized, buy the implied. But it's a very, very near-term thing. You have to be able to act very quickly. B, the tools aren't really in place. Like you said, until some of your realized stuff comes on the market, are you going to be able to realistically put on a delta neutral hedge straddle in time on both sides of the equation, and then also have the it's just it's a difficult beast to on the execution and implementation side, even if you're able to act and identify these scenarios in a proper time frame. So, the moral of the story, the pretty much the primary answer to your question here, what was his name, Tom, is mostly no. It's not something you could really do. I mean, theoretically, it exists. These moments exist. The tools are not there to really take advantage of it. The execution is a huge hassle. Down the road, perhaps it might be a more viable scenario, but you really have to be fast on the trigger finger and also have some really extensive knowledge of the marketplace to be able to execute and capture it. Interesting theoretical question. In practice, like a lot of the things we talk about on the show, a little bit more difficult to execute. But thanks for the question, Tom, and keep those questions coming in. Next up, we have a tweet from at Gin4, and he writes, are there any products out there that replicate vol trades, and he goes on in parentheses, straddles, iron condors, etc., to save me the hassle? And this is another one where it's perhaps a little bit longer answer, but I think the short answer really is A, yes, they exist, but B, I wouldn't really recommend any of them. And let me say why. Is that, a lot of these products have sprung up. We call them structured products, really. A lot of them have sprung up over the past couple of years, specifically targeted at either the busy asset manager or advisor who is somewhat cognizant of options and the need for them, but not really doesn't have the time or B, the inclination or C, the education, or perhaps all three to really implement them properly in his portfolio. And while a lot of these advisors and asset managers have been trained over the years to what they really want to do is just buy a structured product and put it in their portfolio. And so we've seen some success with these products that replicate, for example, covered calls and other types of things. Well, they just write the call for you and they generate that premium income and they put it in your account. Some other ones will replicate buying downside put spreads to hedge or different things like that. Maybe not so much on the straddle or iron condor side. There are fewer of those. They exist, but they're fewer and farther between. But the problem with all of these products is that you're really dependent very much on the way they're constructed. And what we've seen time and again, whether it's an ETF or a structured product, when it comes to these options and derivative structured products, they're not really put together very well. So they're not executed or managed very well. So there's a lot of problems with that, A, not really performing the way you want it to, and B, they charge incredible fees for things that you really could and probably should be doing yourself. So, I mean, we've seen firms out there putting together structured products that will replicate a put and charge you whatever, 3 or 5% for the privilege of doing that for you. And it's absurd. And I really can't recommend any of those types of products out there because they really exist to take advantage of a marketplace that is a little bit ignorant, a little bit time constrained, and so they're charging them a premium to be able to do that sort of thing. I keep looking. I wish there were some ones that were very well constructed, that had very low fees, that performed well, because there is a need for this at the end of the day. I realize not every advisor, not every asset manager, and perhaps not even every busy retail high-end trader has the time to manage, let's say, a straddle or manage an iron condor the way it properly should be managed. So, we keep looking for these types of things that can come in and do some of the heavy lifting, some of the grunt work for you and deliver the vast majority, the lion's share of the returns. It's just they don't exist yet. There's a lot of ones out there that are really looking to take advantage of people by structuring these products the way they do and with very, very high fees built in. And I really can't recommend any. Don, I don't know, maybe you found a few diamonds in the rough that I'm not aware of. But for the most part, I know it's a hassle. I know it's difficult and time consuming, but you really still need to keep doing it yourself. That's usually the best way to get the best outcome on these types of trades.
Yeah, and I was trying to even look around and think conceptually. I was going to say, gee, maybe you came up with an idea there. Maybe someone's going to come out with these pre-packaged straddles, if you will. But I think in the final analysis, there are very few people who go out and buy an at-the-money straddle and just hold on to it and do absolutely nothing for, a month or whatever. It either gets away from you on one side or the other. If you're long, maybe that's good and you take profits. If you're short, you have to protect against losses. All of a sudden, you lose the optionality that I mentioned just a few minutes ago. Well, one of the options delta starts to approach 100%, the other one is worthless. It's not really a straddle anymore. It's just, one in the money option and one hopelessly out of the money option. And so if you prepackage this and you had something that you called the long straddle, both of them, it seems to me that probably sooner rather than later, you'd be wanting to do something anyway with the listed options against that position that you're unlikely to just hold on to and do nothing with for a long time. So as you mentioned, Mark, you might as well just go out and buy the two options anyway. Probably going to wind up trading the individual options or futures or something against it down the line. I'm not sure that prepackaging something like this would have a great attraction again, not to mention the fees that would probably be incurred because somebody is doing the work for you.
Yeah, it's a difficult problem because I recognize the need for some of these things because a lot of these asset managers and advisors are really very busy and don't have the time to implement these trades probably the way they should. But in that case, they probably really should be contracting out to a sub-advisor or someone else like that who is doing that for them rather than buying a structured product. I mean, we've toyed with that idea. You're right. We thought about that ourselves, Don. But obviously, there's an opportunity here for someone to do it properly and perhaps create the proper structured product with a low fee, with the proper management. But until we have the time to really devote to doing that ourselves and making the proper product, and even still, it's not going to be optimal compared to doing it yourself. So, it's an interesting idea, interesting concept. There certainly is a need for it. But right now, I don't see anyone really developing the right tool for this. It really is still, unfortunately, Mr. Jin, for a kind of a do-it-yourself type of environment, which is why we have shows like this, so you can learn how to do it yourself properly, and then you don't have to worry about it.
I recall, somebody will have to look this up, but, I was on the trading desk at Morgan Stanley. I can't tell you if it was in the late 1980s or early 1990s, but the Amex, the American Stock Exchange, came up with a prepackaged vertical spread. It was a bull call spread. They might have had it with puts too. And the idea was that, it bought the lower strike call, sold an upper strike call, and it was prepackaged as a vertical bull spread. And I think that possibly the attraction was that, it would automatically be valued at the full value of the spread, and you wouldn't have to leg out of it at expiration or worry about getting assigned on one side or the other. But the simple fact of the matter was it absolutely did not trade. Nobody cared. And it just died and withered on the vine. And again, I forget what they were called and I forget when it was, but maybe some of our listeners can look it up and write in and find what these were. But this concept of doing some of the classic option strategies like buy rights or verticals or straddles and prepackaging them never really seems to have caught on.
Yeah, it's an interesting area. Obviously, the market has evolved a bit since the late 80s, but it still is a similar dilemma where the people who have the wherewithal to know about even looking for a product like that are inclined to do it themselves because they know about it and they know the value of doing it themselves. So that leaves you really targeting this kind of nebulous mid-tier of people who know enough to want a product like that, yet not have the time to do it. So that's a growing audience, I'll grant you, because there's more and more advisors and asset managers coming into the options game every day. But still, it's a very nebulous area, and I don't think anyone really knows how big it is or how viable it is, and nor has anyone really constructed the right product yet to really do it. We keep our eyes open for it, and if it exists, I will certainly be the first to talk about it. But yet, I have yet to see that proverbial home run product yet. Next up, we have an email from Ed S. He writes, I really want to understand option volatility. Well, you came to the right place, Ed. He says, I've even subscribed to sites that analyze volatility. I'm sure he means some of those sites out there that provide screeners and analytics and whatnot. But he goes on, but I can never figure out what to do with the number it generates. I don't know if the result is particularly high, medium, or low. This is very distressing to me because I know vol is very important, but it simply eludes me. Your help is appreciated. And Dom, when this first came in, I just flagged it immediately and said, this is perfect for the show because this just screams vol cones.
Yeah, I knew you were going to say that.
So by all means, Don, educate our listener here on the beauty and the majesty that is the volatility cone.
Well, of course, once again, option volatility, to try to simplify this for our writer. Option volatility is nothing more than a level or an indication of the relative cheapness or expensiveness of that particular option, because of all of the inputs into the Black-Scholes model to evaluate or price an option. The one that does vary and is subject to opinion and fluctuates the most during the course of the life of the option itself is this input of implied volatility, or the volatility that the person valuing the option wants to ascribe to what's going to happen in the future going forward. And so it's perfectly possible to use these analytical tools that you're seeing and back out this implied volatility number from any particular option that you're interested in trading. And then, of course, your question is, what do I do with that number? How do I use it? What is its meaning? How do I know, whether that makes the option expensive or cheap or whatever? And of course, there's some science, there's some art to that, but bottom line is we can track what volatility has been in that underlying, going back for as long a period of time as you like, and analyze the fluctuations of the real or the realized volatility itself, and then compare the level of option volatility that you're looking at right now and decide where that lies in the general spectrum. And we can say only 90% of the only 10% of the time has the actual volatility of the underlying been as high as what you're going to pay right now. Well, that might be a caution flag. If 90% of the time the actual volatility of the underlying goes on to be lower than what you're paying, maybe the price is too steep right now. On the other hand, when it's relatively low with respect to historical indications, that also could be an indication that the price is right, or that you're not overpaying. And each time I say this, I say it with always the warning that comes with everything in the investment community, which is that past performance is not always indicative of future results. When you look backwards to try to predict something that's going to happen in the future, sometimes the crystal ball is a little bit cloudy. So, it always has to be taken with a little bit of faith. But in general, in any aspect of any kind of trade, if you've got a history of the relative range of high prices and low prices, and you see where that value is right now today, that can act along with other parameters as a guideline when you decide whether the price is right or not.
There you go, dear listener. Yet another plug for Don's favorite treat, and Bob's too, the old volatility cone. Comes in many delicious flavors. I recommend you try it. It's definitely a fun analytical tool. You can, of course, find all types of vol cones over at volex.us. Surf on over there and play with them for yourself, and you can figure out and see exactly for yourself what these tools can do for you. Because you're right, it is Vega in and of itself is kind of a vague number, particularly if you're looking at or historical vol, whatever you're talking about. These are all very vague numbers if you're just coming to options for the first time, and you hear volatility is important, so you're supposed to know about it, but you don't really know what to make of that number. And so it helps to put it in historical context. Looking at historical vol charts and ranges is also important for that, but the vol cone kind of condenses all of that down for you into one very clear and concise visual image. And as they say, a picture's worth 1,000 words. So if you can see where your trade lines up on the vol cone, it at least gives you a better frame of reference for where your trade falls on the old historical vol chart, which can usually be pretty informative, particularly if you're buying an enormous 20-year top in vol.
Mark, when I do my options seminars, I have a particular slide that takes a look at options prices right after 9/11. You remember the markets were closed for a while, and then they were open only a couple of hours a day, and they eased into the full open hours over a period of a week or two, if I remember correctly. And when we finally got completely open again, most people who were around then will remember that across the board, no matter what the industry, the sector, whatever, option implied volatilities were absolutely through the roof. And so if you looked at just about anything and you looked at the implied volatility on that particular day, you'd come to the conclusion that, this implied, if I'm buying this option, is probably in the 98th percentile. And, rarely have we seen implieds that high. And then I have a little workshop where we do a couple of trades with these options and see how they turned out. And despite the fact that you might have, bought a put because you were terribly nervous or whatever at those outrageous levels, it turns out that in plenty of the cases, you actually wound up making money. Now, you probably couldn't make money for a long term and, earn a living paying implieds that were so ridiculously high that 98% of the time they were lower, but that didn't mean that in that particular situation that it wasn't possible to pay what looked like ridiculous premiums and still, wind up being profitable. So it's very important to look at all of this in the context of the moment, along with the historical references as well.
Indeed. Definitely. Context is something we beat to death on this show, but it is critically important. Vol without context is a meaningless number, and it's certainly important to keep that in mind whenever you're looking at volatility. And we're going to wrap things up with a tweet here from, I guess, Tomaton, kind of like automaton, perhaps. I'm not sure how you pronounce that. I love these Twitter handles, but we someone tweeting in saying, both Marks, and I assume he means myself and Mr. Sebastian, slammed buying 20,000 of the Feb 70 VIX calls for 15 cents. What trade would you have preferred to see? I won't speak for Mark because he's not on right now.
Else,
yes,
right?
Exactly. That's the short answer to that question is anything else. That's a terrible trade for so many reasons that we've outlined here on this show and others on the network in the past. We tend to take a dim view as a whole, just naked buying upside like that. It's a terrible trade, very low probability trade. We talked about Delta and the Greeks many times on the show in the past. Anyone with any passing familiarity, at least with even Delta, knows that those trades are very, very low probability. There's a reason why I used to call them lottery tickets on the floors, because they have about the same payout potential as a scratch off. This trade probably even worse. So there's so many other trades you could have done that are preferable to that. I tend to prefer, risk limited types of trades that, things like the iron fly and that sort of thing, where you can really express a view with a limited risk profile on that. This type of trade, when we see this going up, this is usually someone who probably is not particularly sophisticated from an options perspective, and certainly not from a VIX perspective. They don't really understand how VIX works and where it's been. But B, they really seem to be guided more by premium and premium outlay and conserving premium than they are the actual, meat of their trade. That's why we always try to counsel people to come down that strike chart a little bit and get some meatier options, even though it's a little bit more expensive, because the payout profile is so preferable to that. But if you want a specific, I won't speak for Mark, but specific, off the top of my head, I recall when that trade went up, it was about, listeners may remember, someone bought 20,000 of the VIX 70s for 15 cents, and VIX February 70s, and it was just an absurd trade. But I remember around the time, if I recall, that strike chart as it looked, you could have easily legged into, let's say, if you think the VIX is going to gap up beyond 70, which I'm assuming was what that guy is putting that trade on for. Remember, the high of the VIX all time is around 80. So he's looking to get maybe 10 points of juice there. But if you think VIX is going to gap up like that, you could have easily, I think at the time, I remember looking and legged into the VIX Feb 45.70 1x2 for around the same price, about 15 to 20 cents if you worked it a little bit cleverly. And what that is essentially giving you a trade with a dramatically better payout profile for around the same premium outlay. If premium is your sole concern, as it seems like it was this guy's sole concern, then there are so many ways you could have better allocated that money, or perhaps a little bit more money, to a trade that has a much better risk profile, much better payout profile. And if the VIX goes to 100, that trade is going to lose some money. So perhaps if that guy was betting on the VIX to 100 side of the equation, then perhaps that trade isn't ideal. But if you're relatively protected until some decent strikes above 70 there. So if VIX gaps up, you're still looking pretty good on that trade. So there's, in short, like Don said, there are many other trades that are preferable to that. That's just one that comes off the top of my head because I remember pricing that out at the time when that trade went up. But do anything other than just naked buying upside for size, and you're okay in my book. Same with you, Don?
Yeah, I think that when you spend that kind of money, of course, we don't know what kind of money the buyer had, if it's institutional, and if the premium is a drop in the bucket to them. But normally speaking, when people buy lottery tickets, it's spend $1 and buy a dream, because it hardly matters at that point whether the actual expectation is positive or negative. The overwhelming likelihood is you're going to lose your dollar, So in this particular case, you could have even, for some weird reason, I can't see how, but, even if the trade had positive expectation, meaning if you did it millions and millions of times, eventually you'd come out with a profit. You only get to do it once. And so the overwhelming probability is that you're going to lose. You're just going to lose, your premium outlay. So you have to have awfully deep pockets to do things like this. And as you said, there are surely better ways to spend your money.
It's perhaps even more disturbing as I'm looking at the strike chain as we're talking. And here now there's 20,000 open of the Feb 70s, but there's also 24,000 open now of the Feb 65s. So perhaps this same fellow has doubled down on the next strike lower, or perhaps some other market makers are coming in to hedge that trade. There's even 6,000 open of the Feb 80s, Don. So this guy is not alone, or perhaps this is all the same guy. I don't know, in his just complete absurd lottery ticket mentality here. But people are loading up on this absurd upside. And yeah, the moral of the story is anything but that. That's pretty much what I would like to say on that. All right. Thank you to all of you who wrote in. We had some great questions this week, and we love to hear from you. So by all means, keep it up. Comment on the Options Insider. Send us tweets at Options, or on Facebook, or emails, questions@theoptionsinsider.com. It all comes to around the same place, and we'll parse it and analyze it and put it on the show if it's interesting. But with that, we're going to close out the old mailbag for this week and dive right into our Crystal Ball segment.
And now we take a look at the Crystal Ball.
All right, that sad, haunting melody means we're approaching the end of the show. But before we go, we need to peer deep into the murky ether of the future and attempt to divine what the volatility gods hold in store for us. We'll start with you, Mr. Sebastian. What do the VIX/S&P gods hold in store for us for the rest of the week?
I think it's going to be slow. One of the things we didn't get to talk about in the front end of the show was the fact that the S&P curve in the weekly options. So, SPX has weekly options going 30 days out. It is super flat. There is all kinds of opportunities in time spreads. I think it's shocking that I can buy next week vol for the same level I can sell this week vol, considering that there is a pretty important announcement with non-farms next week. There's all kinds of opportunities to trade that curve. So this week is going to be slow and boring, and I think it's going to stay that way. And I think you're going to see the VIX hover between 13 and 15 through probably next Friday. And then maybe it drops below 13.
Slow and boring, ideal for time spreaders and for vol sellers, which is a lot of our audience on this show. So I think they'll like that prediction. And of course, we also like to peer into the future of what NASDAQ vol holds in store for us. So Don, what does your crystal ball say for our dear listeners here from a volatility perspective over there at NASDAQ?
Well, if I have to be true to what we've been discussing, and I invoke some of the vol cones, we are, from a realized point of view, again, at levels that are, 15 to 20% of the time we get this low, and the rest of the time we're really higher. We take a look at our friend Robert Engel over at the Volatility Institute and predictions for realized volatility, but looking forward for NASDAQ are across the board considerably higher. So, we've said it before, it's really hard to make predictions when you basically are trying to extrapolate all the past data into the future, but vol cones, Garch models, whatever you want to take a look at, most of it is telling us that we're unlikely to stay at these low levels. The part that's always tough is the timing. Reversion to the mean simply means that sooner or later you go back to average levels, but it doesn't always tell you how fast you go there. And what we all commented on earlier was that we're just seeing such intractability in the market to kind of go anywhere with these realized volatilities that I'm not going to sit here and be arrogant enough to say that I know that we'll be higher by next week or, even by next month. But the best that I can say is that if you've got a bet on future levels of realized volatility, I'd have to say that, longer term, they're to the upside.
All right. Thank you for that, Don. And with that, we're going to close out our crystal ball segment. And also, unfortunately, that's going to do it for Volatility Views for this week. But before we go, I do want to remind you again to check out theoptionsinsider.com. Check out our new comment system. Let us know what you think. Post it in the comments. Send us an email. Hit us up on Twitter. There's a lot of ways that you, too, can interact with the program here, as well as find many of your other favorite programs on the old Options Insider Radio Network. And while we're talking about online and websites, Don, what's new over in the land of volex.us?
Last week I spoke about a study that we had commissioned with the IIT guys, and one in particular who's done a spectacular job. And Bob Krause and I have been working in collaboration with him. We're kind of putting the finishing touches on what I think will be a rather important study and shed some light on the pros and cons of using something like a realized volatility contract as an overlay to an equity portfolio, and when such a strategy can be profitable, and how it can be allocated perhaps in an active manner to enhance returns from a simple buy and hold strategy. So we're getting very close to what I imagine will be to put that up on our website, and I will announce when it'll be available. The other thing that I wanted to mention is that on at least half of our shows in the past, we've had some wonderful guests, and we want to try to keep that tradition. When we took our little break for the summer hiatus, we were in contact with several people, some of whom were academics and actually were at universities or wherever. And, they all indicated an interest in coming on the show, but said, we're going to be gone for a little while, so why don't you get in touch with us when the school year starts up again. So we've done that, and we hope to have at least 3 or 4 such guests in the pipeline. We're just narrowing down dates and cementing when they might be able to appear, but hopefully we're going to have the same tradition of lots of interesting guests going forward that we had in the past year or so.
Yes, so look forward to that, dear listener, because we have many, many exciting guests on the docket for you in the coming months. So stay tuned for those. And of course, he couldn't join us for the outro here. I do want to give a plug to Mark and Andrew and the guys over at Option Pit. They do some great work over there. So if you're interested in learning any more about any of these topics we discussed at length, then surf on over to optionpit.com. But that is going to do it for us. But before we go, we of course want to thank all of you out there for downloading and streaming and subscribing to the show, as well as for writing in and letting us know what you think of it and asking us such great questions. So keep it up, and we'll see you next week right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volx Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.